That's the closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a moment to get you up to speed on the action from today's trade. Let's start with the major averages here, because as we talked about earlier, it was another roller coaster day, right? So we had some markets start out in the green, but really just a lot of volatility over the course of the session, following closely the tariff headlines from President Trump introducing the idea of a 50% steel and aluminum tariff on imports from Canada, to later in the day saying, well, maybe that wasn't going to happen because the Ontario had pulled back from the idea of an electricity tariff of 25%. A lot of competing headlines out today. So we saw that really reflected in the markets. The S&P 500, which was briefly in the green in the 3 p.m. hour, finishing lower by 0.75% here. And the NASDAQ as well. We really saw when markets were in the green, it was really tech that took it there. But even the NASDAQ finishing lower by about 1/5%. Jared, who always knows the difference between Ontario and Ottawa, take it away.
I'm from Miami. I actually don't, but I'm going to pick it up from here. So let's check out the VIX. The VIX is knocking on 30. Didn't quite hit it. It's come down a little bit, but as I keep saying, it has just been ratcheting higher. It seems very comfortable hanging out in these upper echelons here. Typically, you would expect the markets to reverse upwards. So the stocks and risk markets should reverse upwards at this point. We had kind of the beginning of it at the open today, but we didn't get a lot of follow through. I will say at least some of the stuff that was hit hardest yesterday was able to bounce back, although you wouldn't see it, you wouldn't notice it from looking at this screen right here. Shows tech is the best off, but it was still down about 0.5%. Industrials down 1.5%. So is communication services. So is staples. And then the rest of the line also off by about 1%. So another negative day here. But here's what I was talking about. In the NASDAQ 100, the very largest of the large caps, for the most part, bouncing back today. Apple, a notable exception. It's still number one there. And it was down 3% today. Alphabet down 1%. But here's Tesla up almost 4%. There's Broadcom up 3%. And let me just show you the 2-day, lest we forget what happened yesterday. Still a very, very red board. Put this back in. Let me take a look at the leaders real quick, then I'll kick it back to you guys. Bitcoin on the way up today. So is China. China's been a one bright spot a lot of times this year. And then within tech, we did see some of the smaller names looking pretty good. So unprofitable tech was a day for that, but not the rest of the days this year apparently. So on that note, I will send it over to you, Josh.
All right, thank you, Jared. There is a growing list of companies signaling a cautious outlook as an uncertain economic backdrop now hangs overhead. Here with more is Yahoo Finance's Josh Schaefer. Joshua.
Yeah, Josh, so we've seen a fair amount of guidance cuts for the first quarter, the current quarter right now. So you've heard that from the likes of Walmart, Dick's Sporting Goods, Delta, American Airlines, Verizon, several of those airline companies making headlines last night and into this morning. So I want to highlight what Delta said. So Delta said in its filing that the outlook has been impacted by the recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. The reason I'm highlighting this is because that's essentially what we've heard from most of these confidence surveys we've been talking about over the last month, right? This tariff overhang, perhaps maybe driving a weaker U.S. consumer, is one of the key concerns right now. And I should mention, it's not just Delta cutting its guidance, right? Of course, I named a few other names there. You take a look at FactSet data for the first quarter right now, you're seeing 64 companies have cut their guidance for the current quarter. That's above the 5-year average of 56, also slightly above the 10-year average of 62. But again, you're seeing a broad trend here, which is we don't really know what's going to happen with tariffs. So what happens when we don't really know? Companies sort of adjust how they're thinking about their balance sheets, right? They're either going to take away guidance completely because they feel like they don't have enough visibility, or they can sort of try and model it out and just simply come up with an answer of maybe the consumer won't be as strong, or our company's business and our profits won't be as strong as we try and deal with these tariffs. But right now it feels like it's just, as Julie was mentioning, looking at the market earlier, a little bit hard to read exactly what's going to happen here, right? And so companies are struggling in that as well.
Well, it's interesting, all these growth concerns that bubble up, Josh. I'm still trying to figure out, if that's a risk and a threat. I know it's showing up in the soft data, but I'm trying to, is it really showing up in the hard data yet? I mean, we just heard from Jay Powell last week, and when Jay speaks, we all listen. He said the economy's fine.
Right, yeah, and so I think that's, economists right now are trying to basically say, okay, if we do 25% tariffs on Mexico and 25% tariffs on Canada, here's the base case, right? And I think what the interesting question the strategist brought up to me is, well, how do we then account for what the retaliatory tariffs are, right? And we started to see this play out a little bit online today. So if Canada responds to the US and puts in tariffs, then what's the US's retaliation back to that, right? And how high up does this actually go? And then you're talking about potentially closer to sort of that economic downturn, right? But I think what strategists are saying right now as far as how this is playing out in the equity market is you could maybe map out what EPS could look like for the S&P 500 if we had a clear tariff number and that was going to be the number. But once you start adding in all the other scenarios of how these other countries respond, how we respond to them, that's where the outlook just gets really cloudy and it's not very clear. And again, I think that's what's leading to a lot of the jumpy stock market action you're seeing across the indexes as we get these headlines.
Well, and notably, Jay Powell said the economy is fine. But all of these forecasts imply some future economy that may not be as fine as it is today, maybe.
And of course, we're not pricing how the economy is today, right? We're trying to price how it will be tomorrow.
That's right. Thanks, Josh. Appreciate it. Well, as we've been talking about, the market facing whiplash as the White House goes back and forth over tariffs on Canada and Mexico. The major averages closing lower across the board again, but off the lows of the day. And our next guest says, despite the volatility, it's important to invest in key mega trends. Here to discuss, Jennifer Grancio, TCW head of ETFs. It's good to see you, Jen. Thanks for coming in. So I think we do have to address this macro environment, right? Because it is one that, as we've been discussing, is starting to affect how companies are planning or not planning and what they're expecting. So how are you thinking about it, as it relates to some of the mega trends that you watch?
Yeah, I mean, I think as has been said by others earlier today, markets don't like uncertainty, and we have an enormous amount of uncertainty right now. So we're an active manager at TCW, and the way we think about it is both in the fixed income part of our business. In a fund like Flexer, for example, we're active managers, we're watching the market. We actually think there is some softness. So that fund has been very well positioned for what we're seeing. And then on the active equity side, there are some trends that are long-term and durable. So the question for us is more, how do you invest as an active manager in foundational AI, in how we use power and energy, and in supply chain reshoring?
To be clear though, Jennifer, you're not in the stagflation camp, right? Which is a word that's being thrown around more.
We think right now that there's tension between depressed kind of wages and wage growth and some weakness in the job market, and then what's happening on the tariff side. So again, we don't know on tariffs. Tariffs could come down, or tariffs could be high, which is anti-inflationary.
So let's dig then into some of the trends, and I'll take the AI one because that's the one that has been hit the hardest during all of this going on. We have seen, it feels like not just concerns about macro growth, but also concerns specific to the AI trade that have been affecting some of those stocks. Are these companies spending too much? Where are we in that cycle, et cetera? So do you think there is some room for concern on some of those fronts?
Well, I think if you look at the valuations and you look at the growth over the last couple of years, we've seen enormous growth in these companies. Our view as TCW is that AI is here to stay, this is happening, and we've already seen a big correction at the beginning of this year. So again, we believe in being active managers where we're looking at the quality of individual companies in our strategy. We hold Mag 7, but we don't hold it at the same weight as the index. And we're also holding companies like Deere, for example.
So in AI,
that are using AI.
Have you guys been adding it specifically to some of these, maybe stuff that was overvalued that's now come down specifically within the AI
We
space?
will. I mean, we're doing that carefully. We don't go in and out. We're not trading things tactically, but we are looking at it as a buying opportunity and also looking at adding names of some of the companies that are using and harnessing AI well. So in that strategy, we don't only hold the AI names. We also hold some of the companies that are starting to show progress in that space. And we do believe it's kind of like the beginning of the internet. So the trend is here to stay. There will be enormous growth. But as an active manager, we're going to watch carefully and change weights as we see who wins and who doesn't win.
Jennifer, I look at your ETF. So you got the Transform Systems ETF, the Transform Supply Chain ETF. Is there sort of just kind of a big, broad, holistic view that kind of stitches these vehicles together that you have?
Yeah, if you look at those two, so the tickers on transform system is powered, and the ticker on reshoring and supply chain is the other one that you mentioned. And so for sure, so we think we're in a cycle of both a huge amount of nearshoring and reshoring. Now, there's tension at the moment between Canada, Mexico, and the U.S., but in any case, that trend was already underway, and it's a huge opportunity. So from a supply chain reshoring perspective, it's a huge opportunity both in companies like Taiwan Semiconductor, because all of these new factories and buildings are automated, as well as the actual concrete and rocks and materials that we're using to build all these factories. And then next to that, how do we use energy and power? Right, we're going to have increasing demand for energy and power, and we need new sources, we need new ways of being more efficient. And so they're highly interconnected. The idea of bringing all the manufacturing back and then being able to meet the demand for all of these new factories and facilities as well as data centers, they're massive investment opportunities. And so we think of them as they're not short-term cyclical. They are big secular trends, and we think that people should have them in the portfolio to complement what they've got in the index.
You started to mention Deere, and I apologize I cut you off. I would think that Deere's actually done pretty well over the past year. It's still up about 25%. I would think that Deere would be pretty exposed to tariff risk, right? Is it not? Is that not going to be an issue?
I think a lot of these companies are exposed to tariff risk, and so the way we're thinking about it is, as an active manager at TCW, is we're looking at fundamental quality of these companies. Do they have a model that positions them to grow? In the case of Deere, they're driving up efficiency in agriculture massively. So we can't quite quantify the tariff impact because we don't really know yet how large and how sticky these tariffs are going to be. And so for now, we're continuing to look for companies that are winners over the medium to long term.
And what's medium to long term?
Over the multiple year perspective and onwards, not just in this quarter.
Gotcha.
Jennifer, always great to see you. Thanks for joining us.
Thank you.
On the campaign trail, Donald Trump promising to bring prices down on day one and perform an economic miracle. But just a few weeks into his term, President Trump is talking about the possibility of a recession and blaming elevated prices on his predecessor. So what exactly is going on here? Well, joining us now to help us figure it all out is Yahoo Finance's Rick Newman. Rick.
Hey guys, well, you said what exactly is going on here. Nobody knows exactly what's going on here because you have to get inside Trump's head on this. But yeah, I looked at the difference. It's a stark contrast between candidate Trump last fall and President Trump this fall. Last fall, he said, we are quickly going to turn this economic nightmare into an economic miracle. And he also said, vote Trump and your net worth will skyrocket. So no time frame on when your net worth is going to skyrocket. I think a lot of voters thought that was Trump meant that was going to happen during the first 6 or 12 months of his presidency. Now, not so much. So what is going on here? So there's this new theory. This might sound a little wacky, and I'm not saying I endorse this, but some Trump watchers are saying maybe Trump actually wants to get a recession out of the way early in his administration for a couple of reasons. Number one, still close enough to the Biden administration that he can say that recession started under Biden. I'd had nothing to do with it. He's already taken that line on inflation. And number two, if we do get let's call it a mild recession this year, then maybe we will be in a recovery by the time of the midterm elections, which are basically 18 months from now at this point. I think there's some problems with this theory, but for people who are wondering, Trump is unrelenting. I mean, markets are tanking and Trump just keeps layering on more tariffs. Why is he doing this? That could be part of the explanation.
Rick, we've talked a lot about the sort of support that the party has thrown behind Trump here. And what, if anything, could change that? Could some of this economic pain, if they're hearing from their constituents, is that something that could start to be problematic?
I don't think so much about what would change views of people in the Republican Party, who basically at this point, almost all Republicans are the Trump base. They're going to stick with him no matter what. But they're only a third of the electorate or more, and that's not the reason Trump won in 24. He won because he got moderates, centrists, and independents, and it's the direction of those people who will tell you what's happening among the electorate. So, Trump's approval rating is still in the mid to high 40% range. I think it's trouble when it gets below 40%. That means he's losing the centrists. And I think the dynamic here is that for those of us in the news business and those of us who follow markets every day, we're kind of horrified. I mean, like, it looks like Trump is driving markets down deliberately. But for people who are not, don't pay attention to this every day, or even don't have a large portfolio to worry about, I think they're not going to really worry about it until they start seeing problems developing in their own lives. That would be stuff like seeing prices go up. When prices go up at the grocery store or at the gas station, people see it, and that's all you need to tell them. It doesn't matter what's in the headlines. If we start to have layoffs and people start to see that an important local employer is getting rid of some jobs and that affects some other businesses, then that will start to turn people against Trump. And it's really too early for that to be happening for the most part. I think it probably is happening in some of the federal locales where we're having all these federal layoffs, which will affect a lot of local economies, not filtering through to the real economy just yet, but it's coming.
And you'll be there to keep us posted, Rick. Thanks a lot.
I hope so.
Appreciate it.
I hope Doge doesn't come for me.
It will. You're safe. You're safe, Rick. Thank you. All
Bye,
right,
guys.
all week long, we'll be providing in-depth coverage and interviews with leading Wall Street experts from S&P Global's annual CERAWeek Energy Conference. On the other side of the break, we'll hear from Constellation Energy President and CEO Joseph Dominguez. Stick around. Much more market domination over time still to come. Constellation Energy specifically and power companies more generally have been closely tied to the AI data center trade over the past year or so. And that's because those data centers, of course, need a lot of power. What's next for the power trade? Joe Dominguez is joining us now. He's CEO of Constellation Energy, and he's joining us from Houston, where the CERAWeek big energy conference is going on. Joe, thanks so much for being with us.
Julie, my pleasure. How you doing?
I'm doing well, thank you. So first of all, I want to start with this sort of cadence of incoming interest that you're getting from the data center operators. We know that these companies are spending a lot of money this year on building out these centers. We know that they want power for those centers. So I'm just curious, over the past year from then to now, kind of the cadence of how things have changed, if they've changed, and what kind of incoming interest you're getting.
The pace of actual deals is about the same as it was last year. The kind of frenzied interest has settled down. I think all the clients in this space, the hyperscalers, the data center developers, are all starting to figure out the energy business and are a little bit more rational in terms of how they're approaching. And by that I mean they're not like going to 20 different places to investigate the possibility of interconnecting the same data center. I think they're more targeted now, and the conversations I think have kind of rationalized a bit.
Is there a particular power source that you're finding they're most interested in? Of course, you guys signed that deal with Microsoft to restart one of the reactors, the nuclear reactors at 3 Mile Island, and nuclear has been a big buzzword, but are they sort of agnostic as long as they're getting an adequate, steady supply of power?
I don't think they're agnostic at all. They want clean and reliable power. In fact, a number of these customers have doubled down. And I'm talking about the hyperscalers in particular. They've doubled down on their climate-related goals and their desire to hit that. I think as you move away from the hyperscalers and you just talk about data center developers, and there are a number of big ones, but from big to small, then I think the focus on the clean part of it is less important to them. But clean and reliable in terms of the big plays are the two things they want. And the only place you could get that really is with nuclear in most parts of the country. So that's why the focus on nuclear.
And I want to ask a little bit more about that, because that Microsoft deal I mentioned, so far, that deal got a lot of attention, obviously, when it was signed. But so far, it's really the first and so far only deal of its kind. And so I'm curious if you are in discussions on more like that, and if you think more will follow either from Constellation or in the industry more broadly.
Yeah, we are in more discussions, and I'm confident more will follow. There has been another deal announced. Of course, Amazon and Talon announced a deal at the Susquehanna facility. So there's a couple out there. There are more deals that have been announced in terms of building new nuclear and kind of joint development work that companies are doing with hyperscalers. So, look, I think I think more deals will come. I think the folks have to understand that we are talking about deals that dimensionally could run 20 years, could involve $5 or $10 billion in nominal value. Those things don't get done overnight. And so you could be in negotiations for literally 5 or 6 months, even after you've negotiated the financial aspects of the deal, just working through the T's and C's.
And I'm also wondering about the regulation of all of it, because there's been a lot of talk by this administration about deregulation across a lot of different industries, right? One of the most regulated industries is nuclear, with good reason, one would think. So what do you think does need to change on the regulatory front for nuclear specifically when it comes to going forward and sort of the increased demand that we're seeing?
Yeah, look, I think one of the things that has slowed the process up a bit is we need to have some clarity in terms of the co-location of nuclear and data centers, as an example, or any power plants and data centers, so that they could operate together. And the reason you want these things close together is you have a customer that has a big demand, and of course you have the power plant right next door. That limits the amount of transmission that you have to build and substation work that you have to build. So the data centers want to come close to the plants as a general rule when they need this much power. And so there needs to be rules of the road for how to interconnect those. I think the focus of the administration on speeding that process is something that's resonating through all regulatory agencies at this point. No one misunderstands how important this technology is, not only for American business, but for our national security as well. So they want to get the rules done, but these are big, complicated things. And I think people have an expectation that they get done overnight. And as you know, in any kind of regulatory process, even one that's moving quickly, you could spend 3 to 6 months just ironing out the details among the many stakeholders. And that's what we're seeing. But we're seeing a lot of activity that's positive, and we think will lead to some clarity that will actually be pro-deal.
Finally, we've been talking all about nuclear, but I do want to ask about natural gas as well. The prices have been rising to some extent once again. So how does Constellation sort of manage for that? And when you think about the power generation mix from Constellation, what do you think is the sort of ideal mix given the cost landscape right now?
Well, look, we serve about 75% of the Fortune 100 commercial and industrial customers. And I could tell you that it is rarely the case that any customer uses only one fuel type over the course of many years. Yes, we've done more with clean energy, whether it be nuclear, geothermal, or renewables with these customers, but it takes a comprehensive portfolio of resources that match up to the customer's locations, each and every place they might do business, right? So you need resources that do a great many things. Nuclear is great for baseload energy, but for peaking, gas becomes really important. So we announced earlier this year the acquisition of Calpine, which is the nation's largest natural gas company. So we will have under one roof, so to speak, post close of the transaction, which we expect later this year, the largest nuclear fleet, largest natural gas fleet, largest geothermal fleet, a leading provider of storage and customer solutions. So you see where we're trying to go with this. We're trying to be the low and zero emission resource that is also very reliable. We want to put that under one roof so that we could provide customers unprecedented duration and price certainty, and that becomes really important. Look, if you're spending tens of billions of dollars on a data center, the last thing you want to worry about is what natural gas prices were yesterday or what they're going to be a month from now. You want price certainty because you want to solve for that variable. There are enough other variables in the business, as we all know. So that allows Constellation to play in that space, and for any particular customer, we could blend those resources in a way that meet their sustainability goals, but most importantly, their price certainty and reliability goals. That's what we're trying to do here at Constellation. I think we're going to be able to do that next year.
Joe, it's great to see you. Thank you so much for joining us.
Time now for what to watch Wednesday, March 12th. Going to start off on the tariff front after President Trump said this morning he would be imposing a 50% tariff tomorrow on all steel and aluminum imports from Canada. Trump now saying he will back off that increase after Canada suspended its 25% electricity surcharge to the U.S.
And sticking with the economy, a key piece of economic data coming out tomorrow with CPI. That's the Consumer Price Index. Economists forecast that inflation will cool in February, with total CPI slowing to 0.3% on a month-over-month basis and 2.9% year-over-year.
And taking a look at core CPI, those numbers also expected to slow, with the year-over-year estimate ticking down to 3.2%, suggesting inflationary pressures are still present as the Fed prepares for its interest rate decision next week.
And we've got earnings too. Adobe announcing results for the first quarter after the closing bell. As is the trend with earnings this season, analysts expect AI to be a focal point of that report. Investors hope the company's Firefly tool, which allows users to use generative AI across its suite of programs, will gain more traction.
And moving over to housing, we're going to be getting weekly mortgage application data in the morning. Applications were soaring in the last report to more than 20%. This coming against the backdrop of mortgage rates declining for 7 weeks in a row.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.